Well, it's April 4th, folks, and it has been a hell of a week in the stock market as Trump's tariff news has caused a stock market crash, leaving very few holdings untouched. I'm going to share with you this week what we did within our portfolios, what we bought, what we sold, what I'm seeing in the markets, and where there might be some opportunity. And more importantly, we're going to discuss whether this decline is a buying opportunity or the beginning of a bear market, because the difference is really important here, folks. So stay tuned. There's a lot to come. I'm also going to cover what's going on in gold, as well as my sell approach to gold and interest rates. Man, things happen in interest rates. You got to see this, folks. All right, well, welcome to the Quiver Financial Weekly Market Report for April 4th. If you happen to be sensitive to the vices of life or poor language, you may want to skip this week's episode, because I have a feeling I might get a little unhinged in this one. So let's all start off with just having a little sip of a drink, because this is going to be worthwhile, folks. You're going to learn a lot in today's episode, because I'm dusting off my little playbook. You guys have to remember, I've been through this before. Started my career, a little vodka. Oh, we need a little squeeze. Started my career back in 1998. And right when I thought I knew what I was doing, we went through one of these markets in 2000 when the dot-com era burst. Then we went through it again right when everybody thought everything was fine and dandy in 2007 and 8 after we made a ton of money in real estate. And then here we are again. So I'm going to dust off the playbook of bear markets and market crashes for you, so you can see what we're doing within the accounts. I'm going to specifically really talk about the equity markets today, because that's what has everybody's attention, and rightfully so. However, I'm also towards the end going to talk about what we're doing in gold and also what's happening in interest rates, because you're going to want to make adjustments there if you're owners of anything in those spaces. So I'm going to go through what we did within the Quiver portfolios this week, what we sold to create cash, what we took profits, what we're looking at buying when the time is right. So I'm going to walk you through this process as best as I can. And if you're a Quiver client, here's where we are. I've had a few phone calls from people, a few text messages going, oh my gosh, are we okay? So we started this process as of about Tuesday. The Quiver financial models were all up anywhere from 9 to 11%. So we started off not in bad shape. And as of today, not today's closing prices, we still are up more than 5% for the year. So far, for us Quiver clients, we've been able to manage this quite well. But I'm going to forewarn you. If this morphs into a much worse market, if it turns into a bear market, everything does roll over. So I'm going to show you how to handle that. And more importantly, for the Quiver clients, I'm going to show you what we're doing right now to be prepared for if that happens. So let's dig right into this once I find my little click. So we've got a little sip. So everybody sit down, grab yourself a drink. If you got them, smoke them. And let's get into this. Yeah, we're going to need that this weekend, aren't we? Okay, so here's the topics in the news this week. Well, guess what? There was one big topic this week, and it was the shit topic, which is tariffs spark market crash. Is it a recession, a bear market? Because I tell you right now, the market sure does feel like it's trading that way. And if you watch CNBC, holy cow, man, talk about people who have swung on a pendulum. I mean, total bipolar media. 3-4 weeks ago, everybody's talking about all the great opportunities and buy. And now everybody's like just, down in the dumps. You don't even want to interview them. So, that was the main topic this week, what we call the oh shit week. And, we typically talk about the 5 asset classes. And what I try to do is take the news and the topics of the week and tie them into interest rates, real estate, currencies, commodities like gold and oil, as well as the stock market, because your net worth, everybody's net worth, is tied into these 5 things. And everybody else talks about diversification. You have stocks, bonds. That's great if you're 30, 40 years old. But if you're a little more mature, if you're in your 60s, you're in your 70s, if you may need your money in the next 10 years or less for some kind of expense, then diversification really isn't enough. And that's why we do quivercation, which is we get an understanding of the cycles that are in these markets, and then we build the portfolio around it. And the reason we do that, okay, and the reason we do that is because we can start off with investing in themes. Before I get to that, I want to encourage everybody, visit our website, quiverfinancial.com/newsletter. Our most recent market minutes from the boardroom was just released and out there. And we also issued a 401k allocation guide. We do this every quarter. So if you happen to be somebody who's participating to a 401k at one of your jobs, you can use the allocation guide to be optimizing the allocation of your 401k. We take the same market cycle research that we give our clients in our portfolios, and we apply it to the allocations within 401ks. So as you watch today's show, you'll kind of get a feel of how that can help optimize the if your time frame is 3 to 5 to 7 years, then that's what this is designed for. So let's get into this. All right. So our themes, the reason we try to invest in themes as often as possible is because as a Quiver client, I want you to know what's in your account and why. So this year we started off with a theme saying, hey, we believe that Goldilocks is in the house when it comes to interest rates. And what we meant by that is the 10-year Treasury. That's what everybody tracks to track interest rates. If you want to know where mortgage rates are, you add 2. So let's say the 10-year Treasury is at 5%, then mortgage rates are probably going to be close to 7. If the 10-year Treasury is down at 4, mortgage rates are probably going to be somewhere in that 6 range. So today, the 10-year Treasury is closing right at 4%. It started the year close to 5. Our thesis has been that over the next years, if we don't go into recession and we don't go into hyperinflation, we stay between this range. And I talked about how interest rate sensitive investments like traded REITs and utilities will perform well in that until recession fears come. So that's the big conversation today, is with interest rates plummeting down to 4%, are we still in that Goldilocks range, which we are? However, now that it might be indicating recession, does that change the investment thesis? And I'm going to get into that towards the end of the video. Stock market, we talked about it. We started in the January. We showed everybody all kinds of signs that the stock market could roll over here. We told everybody you wanted to see a correction led by technology. We didn't want it this badly. Okay, but that theme is still handling it, or it is still intact, I should say. Now, metals, we had said that metals were in rally mode, and this year it could turn into a parabolic move. That has happened. Not happening in the future. That has happened. That's why I am highlighting it in yellow, because this week we started taking profits on our gold holdings and our gold miners. I'm going to show you on the charts why and what we're going to do with the money. Then oil, we had this theory that oil breaks out higher, and it did until this week, because now with the Trump tariffs causing everybody to be fearful of recession, now even oil breaks down. Even though the tariffs are not on energy or oil, they were excluded from the tariffs. Even with that happening, this is selling off, because in these situations, the professionals shoot first, ask questions later. And that's exactly what's happening today, yesterday. Anytime you see the stock market down 1,000 points in a heartbeat, what we call gaps down, you go to bed Wednesday thinking everything's fine, and you wake up Thursday in the oh shit moment. Well, then, those gap downs is what happens when you have a liquidity event, when everybody's running for the exit. So I'm going to show you how to play this based on the experiences that I've had in the past of being in this situation before. I also had a question from some clients recently. They said, well, where are we in this tariff process? Okay. And they said, are we coming to the end? Is it going to be temporary? Is it going to be permanent? And you know what? Nobody really knows. I mean, everybody thinks it's a negotiating tactic, which most likely it is, but we don't know how long it's going to last. So the thing around the tariffs, the best way I can explain it, and it's a little crude, but the best way I can explain it is there's farts, starts, and shit. And in the tariff situation, we all know that, a fart kind of comes and goes, stinks up the room and is gone. A shart, you go, better go check that out. And a dump is, you know what it's dump. So we're probably right in the sharp mode of this tariff process where we're all going, it's a little bit thicker than that smell I thought it was. So now, will it develop into a big turd? Some people are arguing it already is. We shall see. But regardless, what I'm going to share with you in the equity markets within all this bowel movement talk is what to do next. So earlier in the year, January, we shared with everybody that that the market was tired. We gave you an Elliott wave pattern saying that, we're coming to the end of the fifth wave. That's the big question right now. Is this decline after the fifth wave has happened, or are we just in a correction and we still have one more leg higher in this market? That's the big question. The question is, has the bull market ended and we're in bear market now, or when this decline ends, do we have one more rally to a new all-time high before this ends? So whether that's now or later, we're probably closer to an end than a beginning in a market that started in 2009. So that's really, and then anybody who wants to argue that, I just say to you, you think about over the last 5 years, the stock market has gone up a lot. I don't think people's incomes in the economy has had the same level of increase as the stock market has. So don't think that it's impossible for this stock market to correct all the way back down to the COVID level, because what if everything that happened after COVID is smoke and mirrors, is credit, is just pump and dump, okay, in the economy? We've seen this before. It's happened. So just that's the thing that can hurt you the most. And so it's the most important to understand that. And that's what we're here for. I'm going to keep giving you updates on that as time progresses, because you've got to make those judgment calls in real time. We shared with you in February that all the small investors were in. We talked about that whole theory of, be fearful when everybody's greedy and greedy when everybody's fearful. Last week, I showed you what we were watching for. 2 weeks ago, I showed you what we were watching for, whether this decline would turn from a 3-wave, this green pattern, or a 5-wave decline. We are on this red pattern, no doubt about it. So last week I updated it. We had the Danger Will Robinson Danger Show, and we're on the path, because what I did is last week I said, what's our target? Because we were paying very close attention, because we had added to some of our technology holdings towards the bottom. We were hoping they would hold. Last week, around Tuesday of last week, I didn't like what I saw on the market, so I added some hedges that would protect us if Amazon, Google, Microsoft, if those declined. I was trying to hedge that, and boom, I said, hey, if the market breaks that 5,600 low, our new target is somewhere around 51, 5,200, and guess what, folks? We're there. I didn't think it would happen in 2 days. However, we're there now. So we have last week's target. Let's see here if I still got it right there. You can see, so we got last week's target, which we're approaching right now. And this is where we really need to pay attention, because if the market gets its footing here, and it doesn't look like it is, but if it gets its footing here Monday, Tuesday, and it can reverse course, you still could be in a bull market. That's the kind of caveat, that this level of support. If it holds, it still leaves a lot of questions about bull market, bear market, right? And gives people some hope. But if we slice through this 5,000 level, like, if this is a hot knife through butter, all right, then this 4,000, 4,500 area really does become the bigger target over the next whatever time frame it is. And that's not far from the COVID bottom. And so for anybody who thinks that that can't happen, well, guess what? We went from 6,000 to 5,100, pretty damn quick. So to go from 5,000 to 4,000 is you can already see it happens. So I'm not saying that's going to happen, but that would be the most detrimental to most market participants, and it would get people pretty discouraged, right? So that's what we need to watch for over this next week is, does this 5,100, does our first target hold? And if it does, what does that bounce look like? Most likely, this starts to become a situation that any bounce, you're going to have a lot of sellers going into it. So that's what I'm going to be watching the next couple weeks is what holds. So what did we do this week with everything that's going on? So for the Quiver clients that called me up and said, are we okay? What's going on? Is there anything we can do? Well, on Monday, Wednesday, and Friday of this week, I started taking profits out of our gold holdings. Now, I'm going to show you a couple charts, but the reason I took money out of gold and GDX, and then eventually I started taking money out of the utility sector that we had, like Duke and Exelon. And a lot of people would say, why did you do that? They were the only things that went up on Thursday. Well, that's why I sold them, is because if Friday was going to be a bad day, which it so far has been, then what ends up happening in these market sell-offs is you have a situation that market participants that get margin calls, the statement are saying is, if you can't sell what you need, so like, hey, if you just bought Microsoft or Amazon and now it's breaking down, yeah, you probably want to sell it, but contrarian-wise, you should be a buyer, not a seller. So if you don't want to sell what's going down, you sell what you have profits in. And that's what the rule book tells you. Then the other thing is, when you get into these hugely uncertain situations where nobody has an answer, the other rule that professionals use is shoot first, ask questions later. As an individual investor, if you're playing from home, if you're managing your own money, you can take risks that us professionals can't take. If you're managing your own money, you don't fire yourself. You can ride something down and back up and wait 20 years because nobody's giving you a hard time but you. But as a professional, we can't do that. So those rules, shoot first, ask questions later, and take profits when you got them in this kind of market, are two very simple rules that I've used and I learned from the dot-com crisis, from the '08 decline. Those who act fast first in this situation, it's a burning building, folks, get out of the room. All right, don't hesitate. If the bells and whistles are going off, this is not the time to look at everybody and go, oh, what's that noise? What's that smell? Oh, is it a shark or is it a smart or is it a fart? No, go. All right. So the other thing that we did is on Tuesday, we added some hedges. So on Tuesday before the whole tariff blow up, the market just was trading soft, and I really did not like what I was seeing in the Mag 7 names. For Monday to be a bottom and really get a rally, I wasn't seeing it. So at the last minute on Tuesday, I added to that Mag 7 hedge a little bit more, and I reluctantly trimmed our positions in Amazon, Google, Microsoft, and ASML. Not because I don't want them. I just realized better to have the cash, because if they go lower, I want to buy more of them lower. So it was just a risk management move. So this is not investment advice. I'm telling you guys this after the facts. But nonetheless, these were the moves that I made this week for us and our Quiver clients within our portfolios because of what was I seeing in the market. One, take profits where I had them, so I have the cash to make buys later, and two, trim things that looked ugly and add more hedges to them. So the next moves for us as we go forward will be, how do we put that cash to work that we've created, and when and where do I remove those hedges? Because the hedges work great when the market's going down, but eventually when the market bounces, I need to be out of those hedges. So those are the things that I'll be updating you and telling you about in future weeks. The other thing I wanted to make sure and mention, because I got pretty humorous about this last week, because I was talking about tariffs and what countries might actually benefit, and then this stuff comes out, and all day yesterday on CNBC, it's just everybody talking about Vietnam down, just getting hammered. So I wanted to give you an update, because remember I said to you, hey, boy, this is starting to look interesting. And I told you last week, I'm not a buyer yet. It's just on my radar. I'm watching this. And, and I said to you is that shortly after we first mentioned it in February, it rallied above a long-term resistance line. And I made the joke about, hey, does Jeff Bezos have a Vietnamese squeeze? And there's a lot of reasons. I won't go into that for that. Well, I think we should just put an X on that and shelve it for later, because man, oh man, Trump was not nice to Vietnam. I mean, here, talk about a widowmaker, right? So now, did Lauren Sanchez find out about Jeff's, Vietnamese squeeze? Because this is that same fund, and yesterday this thing drops 10% to rise 4% so far today. Oh man, widowmaker. So, yeah. This is really, it's probably just better to watch this one for a while, and if anything, for now, just eat pho, right? Is that how it's pronounced? Pho? And I apologize to some of our clients, like Mr. Furman and Mr. Alsap, who didn't have the greatest time in the Vietnam scenario. So probably me talking about it, and they probably weren't appreciative. So you gentlemen, I do apologize. All right, so let's wrap it up and talk about why I sold some gold. Last week we talked about the melt-up channel. Today I added this. I said, yeah, write the melt-up channel if you dare, because also know that eventually, if this market, if it gets bad enough, it has, even gold will give over. So, give it up. So this is the chart that I shared with you last week, and I said the sell plan is if you fall out of this crash channel. And I deviated from that a little bit as a professional, because being through this before, like I said, .com era 08, once I realized that the sell-off was a liquidity event, I went to those first two rules, which was sell the profits that you got, preserve them, shoot first, ask questions later. So I really, last week, I started legging out. I sold 10-15% of our GLD and GDX holdings. Earlier this week, on Monday, Tuesday, I sold a little bit more, and then sold even more on Friday, early morning Friday, because my concern is that with Friday's market being so bad after Thursday's market, that it's hard for people not to get margin calls in that situation, and guys will get forced to sell their good stuff. And that does look like what's happened in Friday, because you've had gold and utilities and even consumer staples. They actually held up and did quite well on Thursday, and on Friday they're rolling over. So even the stagflation playbook, from what I shared with you last week, even that is going to have struggles in this environment. It's going to do better than most, but it will struggle. Last thing let's talk about is the 10-year Treasury. This is really important, and important to see, because too low can be bad too. There's a reason rates can get low, and that's usually because recession and things aren't great. So we've shared with you for quite some time that the 10-year Treasury loves to trade in a channel for as long as it can, and this channel has been going on since 2023, between 3.5% and basically 5%. We keep updating that for you, and last week we said that that staying below 4.5% was key, and if we broke below 4.25%, 4% and probably 3.5% would be the target. But the problem is, if you get too low too fast, then it's a fear trade, and we don't want fear, and that's what's happening right now. So here's an updated chart of the 10-year Treasury, and essentially that 4.25 percentage point that we have there became 4% real fast. You can see in the chart with that green line, we split right through that 400. I mean, sliced right through it again, like hot knife through butter. And that quick precipitous fall is saying, the market's saying, uh-oh, we're concerned about recession here. This now makes the target for the 10-year Treasury down here at 3.5%. Somewhere between 3.5 and 3.75 is probably where this starts to find some footing. We've been saying that a decline in rates is good for the traded REITs and the utilities. And yes, if it's orderly, if we went from 4.25 and stair-stepped our way down to 4 over 3 weeks, yeah, that would be good. But when we move this fast, everything ends up getting hit. So even in the traded REITs and in the utilities, investors need to be very careful and manage risk. So that's why we took profits in some of those areas earlier this week. Again, because we had them, we took them. Doesn't mean we won't come back and buy them back, but right now we're in the mode of protection. So what now? I tell everybody, you know what? Pour yourself a drink, have a seat. Where's the camera? There it is. Pour yourself a drink, smoke them if you got them. I think that's what they said in the military. So have yourself a nice drink this weekend. Hopefully we get some nice spring weather. And if you're playing this from home and you have profits somewhere, keep taking them. Take your profits. Recession is not stagflation. So realize, yes, during stagflation, there's some investment theses that I shared with you last week. But if this morphs into recession, it becomes pretty much cash, treasuries, and very few places to hide, which, okay, I'll update you if that's the case. We're not there yet, but I'll keep you up to date. And, most importantly, don't get discouraged. And if you do, I want you to read my next publication. In the Red Zone, we do a quarterly publication called Red Zone Investing. It's for people that are within 10 years of retirement. I'm going to write I've been writing a special piece I thought was about disappointment, but I've morphed it based on some other readings I had from other people and realized I was really writing about discouragement. And the timing of this piece is probably pretty key, more so for my colleagues in the industry, not for my clients, but for colleagues and probably anybody else, especially if somebody gets laid off. This discouragement piece is written to give them a little encouragement. So when that gets published next week, make sure and read it. And the most important thing, be patient. A buying opportunity of a lifetime is coming. I'm telling you right now, when you get these types of declines, if you got cash, if you're ready, this is awesome. I'm telling you right now, if you're prepared like we are, a buying opportunity of a lifetime is coming. This is how people get rich. So don't get discouraged. Be patient. This is like in surfing. This is like having a 4-wave hold down. Like you take the first wave of a set, you wipe out, you turn around, and you have your oh shit moment because, oh man, you see 4 big old peaks coming, and you go, oh. And what do? You got to hold your breath. You got to relax. You got to be patient and know that it'll pass. The more you fight it, the more energy you use, the deeper you're going to sink. So right now, be patient. Buying opportunities coming. I'll let you know when that time is. If you want to start searching, the thing you want to start searching for is look for companies, domestic companies with strong cash flow and a lot of pricing power. That's where you will start your rebuilding of a portfolio. So if you're playing this from home and you're trying to get an actionable idea, start your research there. All right. So the last thing is make sure and read our market minutes from the boardroom. We cover all this in charts and words, quiverfinancial.com/newsletter. And coming soon, our discouragement to the piece I talked about, the discouragement trap, how to dodge the spiral and win. And more importantly, until next week, take care of yourself and take much better care of others in this environment. Take care, folks.